Hey, testing. Let's see if anybody can hear me. I'm just so pissed off at this thing with Chrome that now it like advertises at you. It keeps popping up these boxes, which are so obnoxious. Oh, caps lock. Sorry, I'm trying to log into something. All right, so let's see. Make sure somebody can hear me and we can get off to the market races. So if you can hear me, just say hello in the little question box and we can move everything forward. La 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 la. Okay, people can hear me. So now I will go to show my screen. Hopefully that will work. So when you can see the screen, let me know. Let's see what the market looks like here. So we're still positive. I mean, it's just we came off the, except for the Russell, but we came off the highs. There's a and the positive is nothing compared to, of course, what we dropped yesterday. But we're still on the whole green for the day, still making those bounces. We'll talk about that in a minute. All right. So anyway, let's get going. Do our little thingy here, and then we'll be ready to go. Okay.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risks. Visit the OC website to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay. We are ready to go. So I hope everybody's having fun this week. Got oops. Where are we? Charts. No, not those charts, these charts. So go look at the hourlies, because the week only just started. And we've come down quite a bit, and this is exactly what you would call a weak bounce, right? And because this morning we talked about this. Godzilla. All right. So the bounce lines are pretty simple. The 5% rule is basically telling us that the market will tend, the major indexes will tend to move in 5% increments. The more volume there is, the easier it is to predict. Which is interesting, because if you watch Foundation on, I guess it's Apple TV. It's an old Isaac Asimov trilogy. He was a big science fiction writer back in the 60s, 50s, 60s. He was great. When I was a kid, I read every book he wrote. But it's a similar concept. There's a thing called psychohistory. In other words, the prediction of, it's a psychology taken to a massive scale. And at the time, in the science fiction book at the time, they had this, the human race had expanded across the galaxy, and there were trillions and trillions of people. And they said, when there were billions of people, you couldn't predict human behavior. You couldn't predict the course of history based on human behavior, because it was too random and there were too many variables that could throw things off. Like, for example, the assassination of Archduke Ferdinand started World War I. Things like that. Just, one little incident can change the course of history on a whole planet. But when you've got billions of planets, then all of a sudden you can say, okay, that one instance isn't going to change the overall movement of history at that point. At that point, the tide is so great that there's no individual action is going to change the sweeping events of the future, and therefore could all be reduced to math, which is very interesting to me, because I hadn't read that book in many, many years. But it's true. And it's interesting, because I was thinking about how it applies to the 5% rule, because I was thinking about the same thing. You can't predict individual investor actions. You can't predict any event that may occur in the market. But what you can do is you can be mathematically certain. I don't want to say certain, but you have a high degree of certainty mathematically, which is the same thing that Asimov said, as far as people also. The larger your model size is, the larger your sample size is, the more certainty you can have as to the movement. So when you have a heavily traded index like the S&P 500, when you have a heavily traded index, or even a heavily traded stock, so the S&P 500, oil, things like that, you can then predict the flow. And you don't know which direction it's going to go, but you do know where the resistance points are going to be. And that's what the 5% rule is. It's not that we're predicting where it's going to go. It's that we predict the resistance points. But because the 5% rule is so good at telling us the resistance points, we can then extrapolate and say, well, if that's a resistance point, what will it take to get over it? And that's the thing. So in other words, let's say you have a river and it turns at certain points, right? So if you think about how a river floods, the river goes down and winds and turns and whatever. And a river will crest during a storm. And if you know the amount of cresting during a storm, you can actually predict where it's going to flood and when it's going to flood, right? And you predict that the river is going to flood at the points where the water takes a turn, which causes pressure on the side of the bank, and where the bank is the lowest and where the water is going to be the highest and when the water is going to be the highest. So you can't predict in any individual on any individual day how high the water will be and so on and so forth, but you can predict that over time this is going to happen and this won't happen. So if you think of a house that has a dock that goes out right onto the water at one of the turns of the river, that house is likely to get flooded. But the house on the other bank, on the opposite side, which is 6 feet off, which is 6 feet higher, is almost never going to get flooded. And you can make a very accurate prediction that that's the situation. This is, it would be almost impossible for the higher house to flood, while the lower house is very likely to flood in any kind of storm. So I know my resistance points. I know my high point and my low point of resistance. I can't predict the individual movement within that path at any given time, but I can tell you that it will never go higher and it's likely to go lower. And what is this? It's the same thing. These are your banks, these are your river banks basically, And I can tell you that this bank is going to be extremely hard to crest. What would it take to crest it? It would take a shitload of rain. It's not going to get crested unless there is a shitload of rain. That's what the resistance is telling me. And as a trading line, it's the same thing. So in other words, I know where my resistance points are, and then we apply the fundamentals. The resistance points are meaningless in the grand scheme of things. You can't predict anything knowing the resistance points, and that's why chart people are so crazy, because they think they know what they're doing, but you're only right 50% of the time, because you know, I'm not saying they can't find resistance points. They're good at that. They can trace their lines and figure out points of resistance, but once you trade, that doesn't tell you anything. Knowing there's a resistance point doesn't tell you anything. The stock getting over a certain line doesn't really tell you anything. What it tells you, key resistance points, is there's enough strength and enough interest for people to breach higher. And once they do breach higher, then there's no limit, right? Once the river gets over the 6-foot wall, right, there's no telling how many houses are going to get flooded, because there's a lot of houses up there at 6 feet. There's only one crazy guy who likes to live on the river and doesn't mind getting flooded once in a while, but everybody else lives 6 feet higher. They don't want to get flooded, but when the river goes 6 feet up, all of a sudden 100 homes can get flooded. And it's the same thing. So once it's over, you don't know what's going to happen anymore. You can predict, as long as it isn't over, what's going to happen. So think of it like that. And the larger the model, the more likely it is to obey the rules. So we were calculating the bounce lines, and we said 4350 would be a weak bounce and 4400 is a strong bounce on the S&P. And so lo and behold, where are we? So then what does the S&P do? It doesn't make it. It doesn't even, I'm sorry, what was the first number? No, I forgot. 4350. So the weak bounce is 4350. That's where we're hovering now. We went over it, but we couldn't make 4400, not even close. And now we're falling back to the weak bounce line. Now, in a weekly chart, and weekly charts matter more than daily charts. In a weekly chart, it's okay that we're doing this as we stay over the weak bounce line. So day one, you want to be over your weak bounce line. Day two, you want to be over your strong bounce line. And if you fail to hold the strong bounce line 2 days later, you're very likely to keep falling. Then you're more likely consolidating before move down. Why? Because what's this going to look like? You fell from here. You came down here, you consolidate in this area, up and down zigzags, right? And what are you consolidating for, more likely? By the time you get out to here, you're more likely to be moving down or up. And that's easy. You're consolidating probably for move down. This is the resistance point that you're consolidating at. So that's where we are now, the 4350 line. By the way, it's a bounce from here, 4350. So we did get up over 4400 from the immediate drop. We bounced over it, but it matters what holds up over time. So that's the S&P. And on the Dow, we're looking for 34,000 and 34.4. So on the Dow, 34,000, and look what happens here. 34.4. These are numbers that were predicted. This is predicted off of this fall. So 35.5 to 33.6 was a 2,000 point drop. All right. So 35.5, which was even older than this. So it's even further back. 35.5 was the top. 33.6 was the bottom. And because of that, we predict 34,000 and 34.4. I'm sorry. Yeah, the Dow. 34,000 and 34.4 are predicted. And here's 34,000. And here's 34.4. And by the way, they were 400 point bounces, right? So how much of an overshoot did we get? 400 points. That's another thing the 5% rule tells us. It tells us that we have 400 point increments are going to be your resistance zones on the way back up. Because we made a drop, we divide the drop into 5 segments, 20% drops, 20% of the drop, and we say that's our bounces. So the first bounce is here. Now, by the way, if you're a longer term purist of the 5% rule, you wouldn't be going by the hourly chart, you'd be going by the weekly chart. And if you go by the weekly chart, sorry, you'd be looking at this, and you would not be looking at that candle all the way down. You'd be looking at 34.2 as your bottom. You see that? So the bottom, you don't count that spike because it's an intraday spike that reversed. So you would count the real bottoms over here. And if we blow that up, I guess, a little bit on the dailies. So you see, this is not a week-long spike. This is just 2 days, and it didn't come through there. We really kind of bottom more like 34.2. So not 33.6. So honestly, when you do a bigger picture chart, this will, this bounce is even less impressive. And in fact, you can see that because there's this bounce. This bounce is not impressive, is it? We fell here, and then we came back to here, but now we're here. And on the whole, this is not a very impressive move. And if we go on the monthly chart, you'll see what happens. This is all this is a stick that came in, but it's okay. If we recover, it's going to be not a big deal drop. If we recover during the month, if we don't recover during the month, and we begin forming another downward candle, that means there's more and more pressure to the downside, and you can have a very very nasty drop. Now we're expecting to go back to 37.5, not 37.5. Sorry. Oh no, that's the S&P 37.50. I apologize. So on the S&P, we're predicting to go back to 37.50, which is all the way back to here. That's what we're expecting to see. And that's about 10% lower than we are now. But my point being that these are numbers that were predicted based on, not on today. We didn't say today that this is going to happen. I wrote it today. But it's based on the high and the low. The high and the low. You take the total, take 20% of the total, that becomes your bounces. In this case, I rounded off 960 to 1,000. We call it 200-point bounces, 14,940 and 15,140 on the Nasdaq. So we're not even, so the Nasdaq isn't bouncing at all. So we're not even doing a weak bounce on the Nasdaq. We'd be 14,940. We're not even close to bouncing so far on the Nasdaq, and that's very bad. And the Russell has bounced. I don't know if it still is, but 2190 and 2230. Russell. Yeah, so we're failing. We're above the first line, but we're below the weak bounce, the strong bounce line again. So on the whole, this is not constructive, and that's the point of the 5% rule, by the way. What are we looking for? We're not looking to predict where the index is going to be at any time. It's more about predicting whether or not we're in a constructive period or a destructive period of the market. Now look at the Russell. It's actually gone nowhere all year, has it? It was leading us, but this is a very big consolidating year now. You would hope it's consolidating for a move up, but this is much more likely after 7 months of this. It's much more likely that it's actually topping out. How does the Nasdaq look in this view? Nasdaq is not as dangerously toppy. S&P also, the Dow also is kind of getting like a little long in the tooth at this level for not making a move higher. Now, like I said, though, we know where the resistance is, and look, we cashed out in August. This is where we cashed out. We basically chopped our portfolios in half or less, and went back to cash. Why did we do that? It just looked very toppy to me. Why does it look toppy? Well, we know those are the resistance lines. We know that, and I mean the resistance lines as when we calculate on a weekly chart. If you look at the S&P, okay, what is the story of the S&P? Well, the S&P went from 2,000 to 3,000, and then 4,000 is up 100%, and 4,400 is an overshoot of that. It is not going, when you see the S&P go from 2,000 to 3,000, right? You can see how 3,000 resist, broke over, but fell back, pull back all the way to 2200, but then finally goes over because it has a good solid pullback, and people buy, not to mention all the stimulus and bullshit like that that's been put in since then. So we know this is sort of artificial what's happening here. But the reality is this is what happens when you hit 3,000. You get a test, you pull back, you get a test, you pull back, you test, you pull back, blah, blah, blah. There's been nothing like that here. These are not real pullbacks. This is not any serious correction at all. We haven't had a serious correction. I don't even know if you can count this. This was last year. We had we went down what? 95%. That's not a correction. That's a correction. That's a correction. Kind of, even this isn't really a correction. You expect to see a 20% pullback or at least a 10% pullback to call anything a correction. We might be kind of getting here. You see 45, and now we're down to 43. That's 5% so far. We need 10%. So we want to go 45 down to basically 40. And that's only 10%. That wouldn't even be a huge correction. And I said 3750. That's what I expect to see was 3750, which is just about 20% of this run coming back. Oops, I'm sorry, 3750 is way down here. So that's what we're expecting to see chopped off. And it's not about the chart. It's about knowing that that's where the resistance is, knowing that 4,000 is the resistance line. I expect a 10% pullback from 4,000. The fact that we went over 4,000 is irrelevant. It doesn't change the value. When you're in an auction and somebody pays $50,000 for a comic book, that anyone would have said, when the opening bids were 20,000 and people thought it was going to go for 25,000, but some idiot bids 50. That doesn't mean they're all worth 50. It means this guy paid 50. It doesn't mean that changes the value of all comic books to now double what they were because one guy paid too much. That's what the market is. It's a thinly traded market. It's a low volume market, and some people are paying too much, but not all people. And you can clearly see that on the drop days. As soon as there's any volume, the market starts turning back down. And that's, again, back to when you have a large population, you can predict the price of the market. But when you have a low population, you have no idea what people are going to pay. But when there's a large population of people, they're going to pay approximately or more approximately the correct prices for things. And then you have to take into account the stimulus money. You have to take into account the trickle money from IRAs. Don't forget the employment is well up there. And one of the reasons that the Fed fights for full employment is because the biggest scam on Wall Street is IRA accounts, and 401k accounts. That your money goes into an ETF, and those ETFs buy under rules. And we don't pay a lot of attention to those rules, but you can damn well bet that there's entire teams at the investment houses who do nothing but analyze all the ETF rules so that they know what, at the end of the day, they know how much of each stock these things are going to buy. And that's what they do. They make their money. These investment houses trade like crazy at the end of the day because they know X amount of money is coming in. How do they know that? Well, here's how many people are employed. Here's what the payrolls look like, so on and so forth. And they know how much money will be deposited at the end of a day, and obviously more on Fridays and so on and so forth, depending on the paychecks cycle. But they know all this. They buy the data from ADP. So they know exactly what stocks are going to get bought on what day because it's a freaking computer. It's not just a computer program. It's a computer program backed by a system for the ETF that is knowable by the people, by the investors can read it and find out what it says and how they buy things and what they do. It's not a secret. And they've got X% of this and X% of that. I mean, you can find this out. You go to Yahoo. No, not that one. Isn't there? There it is. Oh. So we go to Yahoo, and we go to an ETF like XLF, for example. And you go to, so what can I find out? I can find out it's a $40 billion ETF, and I can find out that of that $40 billion, 12% is Berkshire Hathaway. 11% is JP Morgan. So well, it's not much of an ETF, is it? I'm just betting on Berkshire Hathaway and JP Morgan. Then we got Bank of America, Wells Fargo, yuck, Citigroup, Morgan Stanley, Goldman Sachs. Surprisingly, Goldman Sachs is not a big part of XLF. BlackRock, Schwab, it's an interesting ETF. This is generally a bunch of high-class companies. But the point is, so what do I know? I know exactly 12% of $40 billion, whatever it was when we saw it. So 12% of the 40 billion is Berkshire Hathaway stock. That means I can divide the Class B Berkshire Hathaway stock over 40 billion, the price of that, and I find out that there's, let's say, 30 million shares of Berkshire Hathaway are owned by this ETF, and I know that on any given day they have to buy another 200,000, 100,000, whatever, 50,000 is going to be bought at the end of the day, and then I can make a calculation of exactly how much effect that should have on the market. If it's a low volume day and they're buying a decent amount of Berkshire every day, I know that probably the stock's going to tick up at the end of the day. That's it. It's not that hard. So you can see how obviously if I sit there and put programmers and computing power to work on this thing, I would be pretty much able to predict how much pressure there's going to be on a stock to go up and down or up on the end of the day. Now, money flows out of ETF sometimes too, but hardly ever. Mostly ETF money flows in from people because every time you get a paycheck, the money comes in and the money comes in. And how often when you're working do you sit there and say, "Oh, I'm going to reverse my IRA account. I'm going to reverse my IRA and start betting bearish on it, or take my money out of this ETF and put it into that ETF." You're not even allowed to do it on a regular basis. You just can do it on a quarterly or whatever it is. So that is called the dumb money. That money is always coming into the market and always going into things. So the lower the volume, the more pressure, upside pressure, the dumb money has. And that's a big part of the market. So all that has to be taken into account when you're looking at the charts and trying to figure out what something's going to do. So you've got the dumb money coming in, you've got the stimulus, you've got the pressure, you've got the extra money on the paychecks and all this stuff, the unemployment things. And by the way, those things started to run out. So the unemployment bonus benefits are running out. The mortgage, the foreclosure forbearance has been running out. Things like that. So a lot of little stuff is happening, but those are slow-moving problems that people have to now cut back, find another job, do this, do that, deal with getting another house, so on and so forth. There's a lot of these are slow-moving crises, but they're going to hit us in the fourth quarter. And already, and this is why I've been saying for a long time, I don't see how third quarter GDP can be 6%. And lo and behold, we'll find out tomorrow morning, but it's going to be more like 3 or 4%. You know, so now predictions have come back in line with reality. But that reality was pretty predictable since we could see it coming from a mile away. It's like, well, let's see. You didn't pass another stimulus. You took away the unemployment bonuses, you took away the mortgage forbearance, and we haven't been hiring a huge amount more people. So what is all this optimism about? Not only that, but we've seen the shipping has slowed down. There's been big problems at the ports. The supply chains are breaking down. The commodity prices are crazy. Look at meat. Here's meat. Let's see, daily. Actually, daily is getting better. But anyway, so for the longer term. But here's like meat prices are crazy high for the year basically. You got metals have come back down nicely. All right, so look at gold. Silver went back down to 2150. Gold's at 1724. And you got cotton has gone completely nuts. And they're advertising on TV now, cotton. It's like funny because they're like, why are they advertising? It's going up like nuts. Orange juice got expensive. Coffee got expensive. Lumber went crazy and came back down. Sugar is now crazy expensive into Christmas. Now, see that's consolidating for a move up. That is consolidating where there's a huge psychological price resistance at 20. But if this breaks over 20, and if we have crop issues with sugar, it's going to be very, very bad. And that's weekly, and that's monthly. And we have had sugar higher than this. But these conditions, this is very likely more moving for it's consolidating towards an up move than a down move. It's just hitting resistance at 20. And the same with coffee. Coffee's hitting resistance. Notice these psychological numbers, right? 20, 200. That's where you finally run into trouble. 20, 200, 100 on cotton, and it's breaking over 100. This is nasty, nasty inflation. This is stuff we use every single day. So it is not going to be pretty. Here's the notes. And they've been coming down. Now, down means more interest. So this is the value of the note you have. If the interest is rising, your note becomes less valuable. So your note loses money if the current notes pay better than your note does. And that's how the bond market works. So we have peaked out. This is a monthly chart, don't forget. We peaked out early last year, and all these are coming back down. And coming back down just means longer term rates are on the rise. All right, let's see if anybody's got any questions. Oh, try restarting webinar. Somebody doesn't have any sound. Oh, how do I make that go? Did it work? Oh, send privately. I don't know if that worked or not. Oh well, hopefully he got the answer. All right, so anyway, so what else is going on? So meanwhile, our short-term portfolio got a nice boost yesterday or the last 2 days. We're back to 43.9%. I don't remember where we were last month, but that's good. We were under 100,000, now we're over 100,000, so that's nice. And the long-term portfolio, surprisingly, has done very well. So we're at 308% here. So that's today it's down 11,000, but we are doing very well. So the long-term portfolio and the short-term portfolio both losing money today. But we had a nice bounce here, and I'll tell you, where are we, Phil's? I go back to what, August 20 something? Oh no, not August. What am I talking about? It was just 2 weeks ago that we did the portfolio reviews. Let's see. A little bit older. 15's too old. Quickly go from not far enough to too far. That looks like a portfolio review. There you go. So 2167. So we were at 2167, and now we are at 2041 plus. What's the short-term portfolio? What? Ah, oh. There you go, 2160. Okay, so we're actually down. So we're down $7,000. But that's fine. I mean, that's given what's been happening. So since shoot, what day? September 16th. So since September 16th, go to daily, hourly might work. All right, great. So on September 16th, we were here. All right, and now we're down here, and we've only lost $7,000 in our combined portfolio. So that means we're super well balanced. And yesterday, The short-term portfolio is up considerably, and the long-term portfolio is only down 10,000. So we should do even better on the way down. So it should start where the short-term portfolio begins outgaining the long-term portfolio, because we are generally bearish. But on the whole, because you're talking about, what was that total? Was 2 million. You're talking about $2 million worth of positions, although mostly cash, of course. But in a $2 million portfolio, we're up and down $7,000 with this mess going on. That's fantastic. That's what you want to be, is balanced. And that's like surfing. Like, the most important thing you have to learn to surf is to stand up and balance yourself on a board. Once you can balance yourself on a board, and I guess that's the same for a bicycle too, right? So I mean, if you don't surf, if the same thing is if you stand up on a bicycle, what do you have to learn to do? You have to learn to just stay on the bike and keep it balanced, right? Once you learn to keep it balanced, then you learn that if you lean a little this way and you lean a little that way, you adjust a little bit here and there, and you turn the handle just a little, that you can make the bike do anything you want. But none of it works unless you know how to balance in the first place. Same with surfing, right? Minor adjustments. But if you can't find your balance, how are you going to be able to make the minor adjustments? And that's the key. You have a portfolio here that is very, very well balanced. And that means we can easily shove it one way or the other. We do not yet know which way we want to push the board. We don't know how we want to rebalance our portfolio. We have made a few adjustments. We have bought a few positions recently. But on the whole, we're just staying in the middle until we see some more economic news, more evidence. We want to know, will Congress shut down? Will the government shut down this week? Probably not. Will they ever pass a stimulus bill? I don't know. That's iffy at the moment. Presumably with the president and control of Congress, I can't see how they can't do something. The Democrats, you think they can do something? Apparently, they're paralyzed. They're paralyzed by the Republicans. And somebody made a point today, which is true, but you don't think about it. But the Senate is not like the House of Representatives. The House of Representatives is based on the population of the state. So in other words, certain populations get a certain vote and so on and so forth. There's a certain, each representative has a certain amount of people that he represents. But the Senate is different. There's 2 per state, no matter what state. And in school, we learn how brilliant the system is. But now you can see where the system falls apart, because the 2 senators from North Dakota and the 2 senators from South Dakota and the 2 senators from Wyoming are 6 very Republican senators who are voted in by 1/10 the amount of people that one California senator has been voted in by. And on the whole, the Democrats were elected by 2/3 of the people. Two-thirds of the total voters are represented by Democratic senators, and it's 50-50 in the House. So the Democrats represent 2/3 of the voters. The Republicans represent 1/3 of the voters. Yet they have an equal vote. Yet they're a tie, and everything in the Senate is a tie, because the Republicans vote as a block and they don't let the Democrats get anything done. And they only represent 1/3 of the people. So that's kind of a broken system. It was designed that way. And at the time, that was a compromise in order to get these big empty states in the government, because they negotiated. Don't forget, we only had 13 states at the time. And the smaller states felt that they were going to get just crushed, and no decisions, no decisions and no government things would benefit them, because they didn't have enough voice and power. So in order to give them more balance, the Senate was created, and the idea of the Senate was that this would be all equal, and everybody has an equal say in the Senate. All the states had an equal say in the Senate, whereas in the House of Representatives, it mattered, the population of the state mattered. But unfortunately, then rules came about, procedural rules in the Senate and the House, that have caused us to have nightmares, because you can't really get anything done without the Senate approving it. So if the president, so in other words, it would be fine if the Senate had disproportionately stateside voices if the Senate wasn't able to overrule everything you do. But now what you've done is effectively given a minority rule to the Senate, and that's been a big problem. You know, I guess it's to some extent checks and balances, but to other extent it's a mess. But meanwhile, our political system is clearly broken. It's a mess. It doesn't work. We're not getting stuff done. And we have all these crises that we just don't even do anything about because we can't even pass the budget at the moment. We've done nothing but budget for this quarter. And we haven't done that. It's not done. Meanwhile, the planet is melting all around us. And we still have this disease that's going to snap back on us because we're doing nothing about it globally. You know, all these countries are solving their own problem, but we're not solving the global COVID problem that needs to be solved. We need to get this virus needs to be eradicated. So we shall see. But anyway, so bottom line is, where do we start this conversation? Oh, your resistance, right? Yeah. So the point being, before I got so sidetracked, the point being that knowing that this is going to be a line of resistance, knowing that 4,000 is going to be a line of resistance, we say, well, that's a strong line of resistance. From, if you look at the run, did we consolidate at 3,000? That's question number one. Did we have consolidation at 3,000? Yeah, kind of. You know, I would call this consolidation. It doesn't matter that it's up and down. The point is they balance, don't they? This balances out with that pretty much. So we have a consolidation line at 3,000. And that means that the run from 3,000 to 4,000 has some legitimacy to it. But even so, then we expect from 4,000, we're going to expect a 20% pullback. So that's back to 38, and a 40% pullback would be to 36. Now, since the run from 3,000 to 4,000 came so quickly, we're probably going to get a sharper pullback because we just never formed any kind of base, and we never paused along the way. And this was all based on stimulus that's not going to continue. So fundamentally, you start thinking of the factors and say, well, how do we get here? Why did we jump 33% in 1 year? What caused that? And are these factors that we expect to go further up than 4,000? Or is 33% in a year getting ahead of ourselves? Now, clearly the economy didn't expand 33% in a year, although inflation did. Inflation's up 10%, but the economy didn't expand 33% a year. And by the way, remember that when you look at these GDP numbers, we have 10% inflation, so therefore the GDP should be up 10% just based on inflation. Not because this isn't growth. Inflation is not growth, and that's very confusing with these. That's a lot of economic numbers being affected that way. But anyway, so point being, so when you look at the chart, and when you look at this and you say, oh, that's way over. So by August we were up here, and I cashed out. I said, well, that's enough for me, because we're basically 10% over where we thought we should be pulling back. We didn't pull back. We went up 10%. We went up more than 10%. But now I certainly expect us to be revisiting 4, and we should actually come back from 4 and mirror this back down to 37.50. So that's my expectation for what's going to happen, that we should pull back to this line. This is a more, oh, where's 37.50 here? So we should come back to this line probably, at least, in a pullback. And from there, we will consolidate, and then we'll see what happens. Then it'll depend on earnings. But is that a reasonable place to be? It's more reasonable. It's something you can kind of accept if there's more stimulus and there's we keep the jobs up and we get rid of the virus and so on and so forth. Then yeah, why not? Because if you look at the long term of the chart, the long run, since 2009, don't forget this is all low rates and stimulus, so all the way through, we were on a path to go about here anyway. So yeah, this is kind of correct. Because if you, I wish I could make it. I can't make a line like that. If you just think of extrapolating this line and just trust me on this and going here, you come out to right about there anyway. But so normal line normal growth, taking into account the low rates and everything else that's been in place. What changed over here? We have the low taxes, right? Corporate taxes were lowered. They're going to go back up. That's going to get erased. Stimulus like crazy, going to go back up. Super low rates, going to go back up. How are you going to continue on this path if all the things that got us here are going to change? We're going to have a pullback. We're going to consolidate. It doesn't make sense that we don't. And not only that, though, but then you've got to look at the fact that you're not getting good value in the market. And in the end, in the grand scheme of things, in the big macro picture, you invest depending on where the money should be. So they used to tell you always stocks and bonds, right? Put this much in stocks, this much in bonds, because they even out. Now, bonds are just a silly investment now. Bonds are just a waste of capital. And that's why the Fed is forced to buy all the bonds, because the Fed is got to buy the bonds that nobody else wants, because nobody wants to give the government their money for 2 years for 2% or 1.5% or whatever bullshit number it is. Because you know that money's going to get eaten up by inflation. If you give the government on a 10-year note at 3%, and you give them $100,000, if there's 10% inflation, by the time you get your money back, it's basically worthless. Or not worthless, but let's say at less than half, probably getting towards a third of what it was worth if it was 10% every year. So if the government's paying you 2% to keep it up, then you're going to get back maybe $130,000 after 10 years on 2% on a 2% interest bond. So you get back $130,000. But well, here, let's do a calculator. Compound rate. Money Shant, that's my favorite. Okay, because I like it. It's very simple. So $100,000, no annual addition, 10 years, 2%. 121, or well, okay, well, so 121,000, worse than I thought, actually. That's terrible. So you'll get back $121,000, okay? But if you were going to buy a Mercedes for $100,000 and inflation was 10% a year, and it goes up, so next year it's 110, the next year whatever, then you're going to need $259,000. So basically, there you go. So in the end, you've lost 50% of your money. 50% of your buying power has eroded over the time you're holding the bond. Therefore, it's a terrible use of the bond. You're better off buying Mercedes, or in this case, buying Ford. Because Ford has been going like gangbusters. Let's take a look at Ford. So Ford has gone up more than 10% this year, and it will probably continue to go up more than 10% this year. And Ford oh, they're not paying a dividend. Damn it. All right, well, they were paying a dividend at one time. So Ford usually pays a dividend, but they're not paying one now. So you have to count on the value. So if we look at it though and say, okay, well, I'd rather have Ford than a 10-year note. All right, because they've got the electric and blah, 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 and they're building for the future. And here's the thing. Tesla, much as I hate them, they've shown the potential for electric cars to be very, very profitable, right? So if it is profitable, even if Tesla is right, if Tesla's wrong and it's not profitable, then Ford's still going to make a lot of money selling electric cars because they have scale. If Tesla is right, though, and you can scale up the margins on electric cars over time, that you can keep the margins that they have, highly doubtful. But in other words, if Ford's margins improve, then they're going to be obscenely profitable when instead of selling internal combustion cars, they're going to start selling electric cars. because the theory on the electric cars is they're more profitable. That's why everybody's putting money into them. But if they're more profitable and you think that Ford is still going to be a player in the electric car market, then why would you not be investing in Ford? Why are you investing in Tesla, who've been at the same price for the year? Basically, they've made no progress in quite a long time. All right, and you think about Ford. Now I got to find my other thing. That, oh, look at that, I found it on the first try. So, you know, Tesla. So here's that's not Tesla. As soon as I've got numbers, I'm like, that's not right. Okay, so Tesla, $800 billion market cap. That's freaking insane. All right, let's like write this down so we don't forget. So 800 billion market cap. 77. My note. 800 billion market cap. They have 50 billion in sales. And we'll do 77. And 5 billion in profit, 5.6 billion in profit. So 5. Let's call it 6 billion in profit for next year. And 6 billion in profit. All right. So Ford has a 50 billion market cap, 50, 800 for Tesla, 50 for Ford. Ford has 127 billion in sales versus 50 billion for Tesla, and Ford makes $6 or $7 billion. Same money. So why does Tesla make more money? Why does Tesla make the same money selling so many less cars? Well, Tesla's money is made on several things, including freaking trading Bitcoin, but they also have all these carbon credits that they sell also, and government subsidies and all sorts of other stuff comes into Tesla. But Ford will get all of that with a lot more sales, with double, triple the amount of sales that Tesla has. So Ford is a much, much better buy than Tesla. And for Ford, you're paying, like I said, $57 billion for $7 billion in profits. With Tesla, you're paying $800 billion for $7 billion in profits. You're paying 100 times here, and you're paying not even 10 times here. So unless you think that Ford is unable to make electric cars, there's no logical reason to pick Ford over Tesla. That's what the market is always about. The market is always about making decisions, but so are all decisions. So when I'm taking a bond investment and I take bond money and say, I'm only going to get 2% back on my bond, or I can buy Tesla, but Tesla only returns 1%. It's 100 to 1 PE ratio. It's only returning 1% on your money. Ford is returning 10% on my money. Ford has a 10 PE ratio. I am way better off buying Ford than I am buying Tesla or a bond. And that's why it gets my money in the stock market. That's why we pick up Ford. So you have to, there's a lot of factors involved in why money goes to stocks and why money goes to bonds and so on and so forth. But as the bonds come up, these decisions get harder to justify. If you're getting 4%, 5% for your bonds, and that's effectively, quote, risk-free. I don't think it's risk-free when the country's $30 trillion in debt, but let's call it risk-free compared to the stock market. I don't think that's really a true statement anymore these days. When you got, when you're the country's $32 trillion in debt, and that's got a much bigger bankruptcy risk than Apple does. I think the real danger from Apple is the country so in debt, they start attacking Apple's profits and trying to claw back the money. But it's a lot more likely the U.S. defaults and Apple stops making money. So but in technically risk-free debt, you've got bonds, and if the bonds start paying 3, 4, 5%, they become much better, much smarter moves in stocks. Now, if inflation is persistently high, the bond market's going to begin to reflect the inflation. And as you know, back in the 70s, we had these insane bond prices. Bond price history. So in the 70s, or it's actually early 80s, whatever. But look at this. We had 14, 15% bonds. And so did Greece, by the way. This is what destroyed Greece. Didn't destroy us. We lived through this. But that's because Volcker started raising rates and raising rates and raising rates and pushing down. I'm sorry. He raised rates to stop the inflation, and then the prices came down. That was what he did. So Volcker came in here and started raising rates to stop inflation. It seems contrary, but people put their money into bonds again because they were getting such great returns. But think about that. Think about taking a 30-year note and getting 10, 15% back on that. Why would you put money in the market? Then you got to make the different decision, right? Inflation might be going at 10%, 12% a year, but if you're getting 10 to 15% on your bonds, and you put that away, you get a 30-year note. It's going to pay you 15%. You're not going to beat the market. You're not going to beat that with the market. That's Warren Buffett performance right there. If you get consistently those kind of returns. So at a certain point, rising rates is going to suck money out of the market. It's going to happen eventually, and the Fed's talking about it, and that's why people freak out when the Fed talks about it, because we're here. This is where we are. This is where we were in 1940. And that was the same thing, right? We were having a war, and we artificially lowered the rates so that we could borrow like crazy our war bonds and everything else we needed to raise capital back then. And also, we were just coming out of the Depression, so that was also the other crisis they were lowering the rates for in the 30s. So here's 29 when the market crashed, and then we had lower and lower and lower rates until we were down to the level, down to almost where we are now. Look, this is what I complain about. See this? This is bullshit. So down to the rates that we are now. We're a little lower now. This is wow. This is this is not a chart. Doesn't even come out as far as we are now, because we're actually here now. We're actually down here. You know, so there's no. But that's the point though. Who's going to buy a bond? Who's going to take a bond that pays that low? And that's, again, so where does the money go? Well, the money's going to go now into where? What's left? You got real estate, you got cash, and your cash is losing value due to inflation, so that's not a good place to keep your money. You got bonds. Nobody likes the bonds. They don't pay enough. You got stocks. The market's on fire. People put money into stocks. And you've got housing, and housing has gotten insanely expensive too. And people, but it's not getting the volume of turnover hasn't happened the way it did before. Why? Because people got burned 10 years ago on housing, and they're not quite that stupid yet. not quite that stupid. So as of such, people are still a little bit leery about starting to treat housing like an investment platform. But stocks, everyone's in it. Everyone's playing it. Everybody's putting money in. Got the Robinhood stuff, all these things going on. That's where the money's coming from. It will not last forever. People will change, and people will move out of it. But we have a while. It's not yet, because the bond prices are still so low that it's not a viable alternative of an investment. But just, you know, you think about what can happen. That's what killed Greece, was when the prices started going up like that. They had no control. We have more control in Greece does, because our central bank sets rates, but that's a matter of confidence. We could have a confidence crisis that crashes the whole thing, because it's all based on the confidence that you have in the Fed and that people have in the US bonds, and that's a tricky thing to maintain when you're basically not paying people anywhere near the going rate for inflation. Okay, So let's take a look at the oil, since it went down, say petroleum status report. This is today, September 24th, yeah. All right, so oil increased by 4.6 million barrels, and gasoline inventories increased by nothing, and distillates increased by a little bit more than nothing. So basically, the big build was in oil, 4.6 million barrel increase. There was no change in input to refineries. That's interesting, right? Look, crude oil input to refineries did not change. So that means that we just basically demand slipped back. Product supplied, look, did not change. 209. In fact, less product was actually supplied than the week before, yet we still had a build. Wow, and that's not even telling the whole story, because look at all other oils. Remember I said they hide their oil in all other oils because it doesn't come out on this report. You got 457 to 462, so another 5 million barrels, almost 6 million barrels were added to all other oils, and you can see the grand total here, 41 to 51, 10 million total barrels were added. So this is worse than you think. There was a change of 10 million barrels of more oil was put on the market. Export stayed the same, so that's not different. Import stayed the same, not different. Everything else is basically the same. So basically, the bottom line is that's a demand thing. We use less oil in the past week than we did the week before, and quite substantially less. Obviously, it's not likely that we went down 10 million barrels in a week based on demand. What's more likely is there was a spillover from the holiday period that caused an apparent draw last week that may not have been as big of a draw as you thought it was, just based on the way they count. Based on, there could be one day that gets counted one way or the other way, and that could throw the whole report off. So it's probably not as bad of a build as it looked, as 10 million barrels, but it also means that the week before wasn't as big of a draw as they thought. And, and again, like we talked about last week, it's all extrapolation nonsense. I mean, they take one data point and they extrapolate it and say, this is what's going to happen from now on. Like Goldman Sachs runs out and says, oh, $80 oil, $90 oil, look at the demand, blah, blah, blah. Where? What happened to the demand? We went from I forgot what the week before was, but the week before was like it was a 5 million barrel draw or something like that, or even worse, and all of a sudden swings the other way to a 10 million barrel build. What explains that? Is demand that volatile? No, it's not. Of course it's not. Was there a catastrophic event? Did anything happen? Was the Northeast snowed in? No, none of those things happened. Not even a hurricane. It's just a balancing out from the hurricane and the storms and the holidays and everything else that happened in the last few weeks. And so as we normalize, then we get a clearer view on what's really happening. But what's really happening is we're going back to the normal measurements we had, which show that demand is still pretty much impacted from COVID and has not really come back at all yet. Yet that doesn't stop us from paying 75% more than we paid last year for oil, and 50% more than we paid last year for gasoline. Because if they can make you pay it, you'll pay it. That's how it works. Look at oil back to 75. So it's most of this push, this giant candle right here, was Goldman Sachs just telling you that oil was going to be $70, $80 a barrel. I'm sorry, $80 or $90 a barrel, but they meant Brent, of course, and they got Brent to 80 pretty much. Oh, I'm sorry, that's not days. Here's days. So on Monday, Goldman Sachs came out swinging and said Brent's going to go to 80 or 90. So they got Brent up to 80, which was their goal. Of course, they were hoping to get it over 80, but then reality kicked in today, and we're not holding that line. But that's, again, you can predict that 80 is going to get rejected. And how much is it going to get rejected? How much was the run? We had a run. Make Brent bigger. Where's your consolidation at Brent? Is it at 70? Is it at 65? Well, clearly 65 is the lower end of the scale, right? So if you're coming from 65 to 80, that's $15. So then you're going to get a $3 pullback. So you're going to go back to 77. That's what you can predict on Brent. And as we can see, 77 right here has been some consolidation before also. Now, on the other hand, if you say 70 is your line, and we can make a case for 70 being a resistance line, and 65 is just a fall below. So if you're in the 70 to 80 band, then you're talking about a $2 pullback, and that would take you back to 78 or 76. So either way, though, we're going to be looking for something lower than we are now, and probably in the bandwidth. And 77 seems like a good target since it's between the two bands of the 80 pullback, and it's the weak retrace of the larger 65 to 80 move. And that's what you have to do when you're looking at the 5% rule. You got to calculate, you know, if you can't be sure of where the support resistance line is, and you can't on this chart because you have too much wiggling around between them. So if you're not sure at 65 or 70, you got to draw them both out. And here so from 65 to 80, $15 move, $3 pullback. So your first pullback line is 77. Then if you do the other one from 70 to 80, it's $2 pullback. So weak is 78 and strong is 76. 77 is right between the other two. So if you combine them and look at where they all converge, they're all converging at 77. That makes 77 the most likely pullback line. And you know, we're at 78.60, so that's $1,500 down from here on Brent. But whatever Brent does, WTIC is going to do too. So then you flip back to WTIC. And we're at 74.80. So we should mirror that pullback of $1.50, and that means we're going to be at 72.50. And then we could do the same thing with our lines and say, well, does that make any sense? And then we say, well, here clearly, much more clearly than the other, because we haven't been at 60 for a while. So we've been at 65, has been consolidation for the whole second half of the year. So 65 to 75, which is also clearly the top, is $10, and therefore we expect a $2 move below 75 back to 73, and we just had 72.50. So 73 would be a weak retrace, and 72.50 is where Brent would match up. So we would expect to at least get back to 73 here, and that's a $2 move down. So basically, with oil at 74.89, we could short here and put a stop at 75. It's, let's say, 75.05. So what's your risk? I already have an oil trade, so it's not going to work on here, but I have two short from 75.66 earlier. But if you started here at 74.80 and you put a stop at 75, well, see this pink line at 75.10. So I'd keep the stop up there. Now, how much is that? That's a $200 loss. It's $10 per point, so it's a $200 loss. So I'm going to risk $200 shorting below the 75.10 line. But the possible win, if it goes the way we think it's going to go, you're going to get back to 72.50. That's going to be, or 73 at least, that's going to be a $2,000 win. So you're risking 200 to win up to 2,000. And that's the way we look at it. So basically, you know, I had a good entry. So my stop here is 75, and I'm going to lock in some of this money. But that's how you make a play like that. You just got to find a spot where your risk is better than your reward. Well, I'm sorry, your reward is better than your risk. That's pretty much the way you want to play it. Anyway, so now we want to take a look at it in the short-term portfolio. I want to see how are our hedges looking. Oh, we didn't do the adjustments yet. Shit. Back to here. Portfolio review, part 1. So where is the short-term portfolio? All right, short-term portfolio. Yeah, see, it was 94,000, and now it's 111. So what's that, like $17,000 improvement? All right, so what did we do? We changed, we got more aggressive with TQQQ, and what happened to TQQQ? We were short on it. We rolled the January 130 puts to the June 160s, so that was pretty aggressive. And we sold some January 130 puts for 1350. Now look, we're getting burned already on the January 130 puts. But that's okay because we can easily roll them. We've got a long time ahead of us. Basically, though, that's 161. That we're at the 160-130 spread. So we've got a $30 spread here that's 100% in the money already. And like I said, we haven't done that roll yet. Chipotle Cmg. What did we do? We sold the January 2000 calls for 75. Wow. That was good. Wow, that was clever. And this is what happened to them. So we're very pleased about that. We did that perfectly because we took it right at the top. Now we're back to 1850. It's a huge help in the portfolio. Is CMG improving for us? Oh, there's a January 2000 call. Oh, maybe I did make those adjustments. Wait a minute. Oh, look, 160. Oh, I'm sorry. These are with the adjustments. I apologize. So yeah, these adjustments were put in. So yeah, now we have the 160, 130 spread. So notice we're down 11,000 on this spread. That's something you just have to be aware of, that these 160s are in the money. So 20 times $30 in the money is $60,000. That's these have a lot of premium in it. These should be 60,000. So the net of the spread is just under 60, but there's no reason to cash it out because the 130 puts can be rolled. Let's see, the January 130 puts. So we go to TQQQ. And we sold the January 130 puts. See, the thing is, they're all premium now, right? Because TQQQ is at 126.50. And we sold the 130 puts. They're currently 20 bucks. That 20 bucks is almost all premium. But that doesn't matter. We also, so we have the June short puts, the June long puts, the 160s. So what cost $20 in June? The 110s. The 107.50s are $20. That's not even accounting for the premium decay. So we're going to be able to roll our 130s significantly lower and widen that spread by a significant amount. So that's when we look at if we're going to cash it out, we say, well, we can cash it out now for just under 60, but we can easily turn this into a 100,000 plus spread. And that gives us additional protection. So, and it's a free roll. There's no reason to change it. This is, like I said, all premium at $19.95. We sold them for $14.30. This $19.95 is $16 worth of premium. So, you know, so those 16 times 20 is 32,000 of this 39,000 is premium. So also this too, but we can turn this into a better roll and make it work. So there's no reason for us to adjust or do anything with that at the moment. What else did we change? Oh, like I said, Chipotle got changed, and that's reflected in here. So these are the ones we sold. We sold them for 77. They're now 54. And again, though, they're completely out of the money. So if they stay out of the money, if CMG stays below 2,000, we're going to pick up the 1,600 bucks. Also, these $1,800 calls that we sold, right? We sold them for 250. Now they're 310. And they're 62,000, but the 250, I'm sorry, the 310, it's only at 1850. So $250 of this, $50,000 of the 62,000 is premium. So if CMG stays down here, we're going to pick up this 50,000 here and 16,000 here, 65,000 will get added to this, and this thing will be suddenly at 175,000. So we could actually have a phenomenal month in the short-term portfolio, or a quarter anyway, to January, just if that happens. So just CMG staying flat, if TQQ stays around where it is, we could pick up $100,000 just on these two, and these aren't even our primary protection. What else do we have? SEO, not working out, went the wrong way. SQQ, let's buy back the short 2023.25 calls, and the rest of the spread is fine. And Wayfair, blah, blah, blah. Wayfair, we cashed out. Oh, well, I missed that. Oh, see, I knew I didn't do something. We didn't cash out Wayfair yet. We should have. I knew I hadn't finished it. I didn't think I did it at all, actually. So QQQ, did we take the advice on the buyback yet? Let's buy back the short 2023 $25 calls. 2023, nope, there they are. All right, so those we were supposed to buy back. And they were brought back when they were 139. So not really much of a price change, no big deal. But in other words, that's just a way we get a little bit. And remember I was talking about the surfing and the minor adjustments? That's what we do. You're just getting a tiny bit longer. So in other words, we're well balanced. We have this position, and the 2023 $25 calls we're hitting us for $6,000. We buy those back, and what do? We're taking away this pressure of if there's an upside move against us. And in this case, it went from 6,000 to 8,000. So by buying them back, we saved a couple of $1,000s of a loss there. And most importantly, though, we freed up a spot so that if there's a spike in SQQQ, we get to go back and sell it again. But these are really, really minor adjustments. But it's that same thing when you're surfing and you're balancing and you want to go left. You don't just and turn left. You make a little adjustment and you nose the board down and you move forward and you move along and head in that direction. Or just like a bike when you tilt, I want to make a little bit of a left turn, you tilt a little bit to the left. You don't necessarily rip your handlebars to the left and jackknife yourself, right? That's not the way to do it. All right, let's see if anybody has any questions. Neil says, would you recommend setting up a new TQQ now? Would you recommend a different hedge? Yeah. No, the problem with TQQ is it's extremely volatile, and we really only like it when the Nasdaq is super toppy because we feel that we can get a really good price for the when we sell calls basically. So right now we're not in a position where we'd want to be selling the calls on TQQ because where is it? In other words, when it's up here in a channel top like this, we feel comfortable selling short calls and collecting the premium, and we like and also the puts that we buy have a good price. Once you're down here, that's what I'm disappointed about is the premium that's gone into these short calls now I'm sorry, the short puts. There's a huge amount of premium in these things now. They're all premium, in fact. Like, what do we say, 32,000 out of this? So it's almost all premium. So we don't want to, for selling it, yes, but for buying it, you'd have to buy something much more expensive. It's a little bit more messy. So you want to try to find something that's stretched. Now, still though, the SQQQQ, I think I said too many Qs, SQQQ. So SQQQ. Oh, well, that popped too, but that's a more reasonable sale. So back in the early September, we were at like not even 750. Now we're at 850. So you can see how fast these things can move. And you can buy those for a pretty reasonable price. So if you look at an SQQQ, also depends on what you're trying to do, on how you're hedging. We're hedging we're hedging very long-term positions. So we have a different take on it. But if you're in the SQQQ, the trick is the same all the time though. Don't pay a lot of premium for the longs, sell a lot of premium for the shorts. So the way I would do this is I would buy, we're at 850. The 6 is at 380. The 4 is at 480. Now see here, you're paying, so the 4 at 480, you're paying $8.80 and we're at $8.40. So you're paying 40 cents in premium, right? At $4.20, you're paying $9.20. That's 80 cents in premium. That's starting to get a bit pricey. And then 6 is $3.70. That's $9.80. That's $1.40 in premium. That's too much already, clearly. So I would like to look at the 5s and the 4s maybe. But I'm trying to think of how you offset that. So I think I would go with these, with the SQQQ, the 2023 $4 calls. Although if I'm going to do that now, I'm going to look at 2024 and see what they cost. The $4 calls here are, well, you can't tell because their spreads are too wide and nobody's buying them. Too wide, no. So these aren't reliable. But what I would do, given what I'm looking at here, I would here's what I do. I would sell. Wait. See if I can pop up. La-di-da. Need a comment box. All right. Back to that. And back to that. Oh, damn it. There we go. Okay. Squish that up a little bit more. Okay, so let's say that we buy 100 of the 2023 SQQQ 2023 $4 calls for, oh shoot, every time. Why can't I see the strikes? Oh, because they're over there. That's so annoying. You are kidding me. So the $4 calls are $4.70. 4.70. And that's going to be $47,000. And then you sell 50 of the SQQQ 2024. What are these? These are the 8th. Now this spread is 280, 460. So I'm going to say it's going to be 320. Let's say these are 320. That seems like a reasonable price. So, whoops. So then you want to sell the $8 calls for $320, and that's $15,000, $16,000. Is that correct? 320 times 50. Yep. Okay. That's $16,000 there. And I wouldn't sell them now, but when you do get a spike, I would want to sell something shorter term, like the January. Well, the January 10s are already $1, so that's pretty good actually. I don't think I want to sell those though. Well, no, I guess you got to. So let's say we sell these are 105, 106. So then we're going to sell for 105, 106. So sell 50 January, SQQQ, January $10 calls. For and that is $5,300. All right. So if you do that, then your net is Let's see. So your net is 47,000 minus 21,300. So your net becomes $25,700. And effectively, you expect to be able to sell these every quarter. So you're going to be able to knock $15,000 off that price over time, and you'll get down to about $10,000 total cost for the spread. So if all goes well, you should be able to sell those on a regular basis. If not, though, you're going to roll them, and you can obviously roll them to the eights. So in the very least, you have a 4-8 spread. You probably have a better spread than that. But even a 4-8 spread would be a $40,000 spread. But probably you're going to end up with a much better spread than 4-8. You've only got half covered here. And over time, hopefully, if you get rid of these 10, so you can get, let's say you average upside is 12 on 50. And that means it would be 50 times $8 would be 40,000 there, and you have another 20,000 there. So you have a $60,000 spread that you're going to pay less than $25,000 for, and that becomes your protection. Now, when you get to 202, when you get to the end of 2023, you have to then pay money to roll your protection down to 2024, or these will be low enough to cancel out. And what do I mean by that? If you had done that now, all right, if that had been your plan a year ago, and now we're at that point, you would have your January. I'm sorry, that is this January. You'd have this January 4s, and your 4s would be still 335, right? So you maintain that money. The 2022, the 2023 8s would be $3. So and where we set up now, the way we're set up on the spread is that, so these 8s would not have lost, the 8s didn't lose much money. You lost about $1 here. So your cost of the spread becomes $10,000. And if we offset that by selling shorter calls, you have no net cost. And then you do your roll and you spend the money for your next 2 years of insurance. But if it pops, what happens is both of these guys lose their value, lose their premiums, and you end up making your $4 or a good portion of your $4, plus you're only half covered. So it's not going to run you into danger. So I would rather do a setup like that for now than play with TQQQ, because I just don't see it as being as easy of a payoff for it. So I hope that made sense. It's a little more complicated, but we're trying to sell the premium. That's the key to the whole thing. All right, so what else? How's the market holding up? Shorts. Ooh, getting a little bouncy. You know, so look, what we're going to do is we're going to watch for the rest of the week. We're going to, if we get to those strong bounce lines, we're going to see if this is overcome. But it's really all about the macros. You got this major stuff happening with GDP tomorrow, which will be disappointing. We'll see how that's digested. The Fed comes rolling back, though, with their calendar, which we had on Monday's thing. So what do we do on Monday? Okay, so we're getting our GDP at 8:30. We're getting corporate profits in the that always comes in the GDP report. The Chicago PMI. Then comes Williams, Parker, Evans, Bullard. So lots of people speaking to soften the blow or change or give us direction or whatever you want to call it at this point. These guys are speaking very late though. Then Friday is personal income, but no non-farm until next week because it's too early. PMI manufacturing, ISM, construction, and then we got Harker again going on again. So we have a lot of Fed speak coming in after the GDP report. They're trying to make sure that we don't end the week on a sour note and that things look okay into next week. And next week we get the non-farm payrolls, of course. And after that, earnings season. And then we start deciding what we think looks good and what we want to invest in. But at the moment, I'm way happier just being cautious and sitting back and you know, just watching what happens unfold without getting too invested in it, because It's a really crazy market. Brendan says, any play on silver or gold? Well, that's a good question. Like, my play on silver and gold is not to play silver or gold, but to play wheat and precious metals. Okay, which are they're playing the gold market for you. They're playing the silver market for you. These guys buy discount contracts from the miners and sell and try to time the market and sell it. So they're constantly buying from the miners at a discount and selling it. So why pay retail price for gold when you can buy this company that has a revenue flow? And people always overestimate the impact it's going to have when prices drop on these guys. It's actually good for them when silver prices drop because they're not stupid. They buy a lot of contracts. They don't buy. Same problem with Hovnavian. Like, people think Hovnavian is stupid when they're investing, and they're like, oh well, this has to be hurting them because housing markets crash, or this has to be great for them because the housing market's good. No, these guys time the market. They're not idiots. They look at the conditions and they sell more when it's cheap. I'm sorry, they sell more when it's expensive and they buy more when it's cheap. And that's what Wheaton does also. So let them do that for you. Wheaton has no mining operations. They are hedging gold. They're hedging gold and silver contracts. But they buy everything at a discount. So when you see gold prices go down, they're buying it even cheaper than that. And that's what makes them a good investment for silver. Well, I use them as a proxy for silver, not for gold, even though most of their operation is gold these days. But for gold, there's nothing better than Barrick. And you see Barrick Gold, even though gold is completely crashed, Barrick's having a hard time getting lower than this area because this area is a ridiculously cheap price for Barrick. So 1850, 1750 is fantastic for them. They're not going to go bankrupt. They're just going to make less money selling gold for a while. But you see, the difference between wheat and precious metals and a miner is that Barrick makes their money selling gold. They're going to sell gold whether it's expensive or whether it's cheap. They're going to sell gold. That's where their money comes from. That's their job. Sometimes they do really well. Sometimes they don't do as well. But overall, as a miner, the thing that I like about Barrick is they have the lowest extraction costs in the industry. They basically, what they do is they'll buy an entire miner's operation and they'll sell all the pieces off except for the most productive mines. And they always, and of course, they're only buying the operation because they say, oh, we can improve this, we can improve that. That's why they're buying it. But usually when they buy a miner's operation, they keep very little of it and sell off all the pieces because there are lots of people who are very happy making a little bit of money with a gold mine. So you can sell a gold mine to individual investors who don't have billions of dollars, who are happy to buy one gold mine and mine it and make their money. It's a great business, even if it's very marginal. As long as you're making $100 an ounce selling your gold, what do you care? You're pulling gold out of the ground, you make $100 an ounce. People make $1 million, $2 million a year with their little gold mine. It's great. Barrick doesn't want that mine. They want a mine that's going to make $1 billion a year. They want a mine that's more efficient, that makes $200, $300, $400 an ounce. So when they have a $100 an ounce mine, they throw it away. That means they have a lot of low-cost mines though in their portfolio. That's what's great about them, especially in tough times. In fact, when times are tough, it's to their advantage because it means they get to go shopping and buy up another miner. When times get tough, other miners get in trouble. They sell off their portfolio. Barrick swoops in and buys it. Then they go through the same cycle again. This is what Hovnavian does with properties also. Hovnavian swoops in bad economic times, buys a ton of land, and holds on until the market's better, and then they start building on it. You got to respect these operations. These cyclical companies are fantastic for this stuff. And so for either one of them, they're both cheap now. So what do you do when the stock is down? Oh, it's their old symbol. So what do you do when the stock is down? You go long term and you sell puts. Barrick's at 1750. You can sell the $20 puts far out for almost $6, $5.80, something like that. So if you sell this for $6 at $20 puts, you're netting in for $14. Don't psychologically let it bother you that you're selling the $20 puts and the stock's at 1750. What do you care? You care about the net. So if you get $6 for the $20 puts you're netting in for $14. That's all that matters. So frankly, that's all you need to do on that trade is just sell those and relax and sit down. And if the market goes up, why does it not matter? Because here's the thing. If you were going to buy a bull call spread now, you would buy the $15. Remember, we don't want to pay too much premium, so you go on the money a little bit. We want to buy the $15 for $4.60, or do we want to buy $5.70 for the 13s? Well, I'd buy now. I'm going to buy the 13s because I'll pay $1 to be $2 more in the money. So we're going to pay $5.70 for the 13s, which is a net of $18.70, and we're at $17.60. So we're paying $1 in premium. And then we would sell, I guess we could sell these guys for $3, the 20s for $3. And now we pay, what do we say, 570 minus 3 is going to be 270. So we're paying 270 for the 13 $20 spread. For the $7 spread, we're paying 270 for the $7 spread. So did I say do that? No, we don't need to do that because we're collecting $6 here. That's enough to pay for 2 of these spreads and have money left over. So we could buy 2 times as many of these spreads. But what happens if Barrick goes up 250? Well, if it goes up 250, we would end up getting the 15 spread, the 15-22 spread, let's say, and that is currently 350. So basically it would only cost us 80 cents if Barrick goes up $2 or probably less than that on our spread. So waiting isn't that harmful to us. And not only that though, but that means our puts would be well in the money. So it's better. The best thing we can do is just sell the puts and wait to see if it's definitely bottomed yet. If it has bottomed, great. If it hasn't bottomed, then we're going to get a better spread, a lower spread, cheaper down the road. But we can always do it because we have all this money from the short puts. And if it goes higher, we're only going to be sacrificing $1, but the dollar doesn't matter to us because we're going to be making $6 on the short puts, and we're going to get we're still going to get a great spread price. It's going to go up 100% on us. So that's what you have to do. You have to be patient when things are coming down like this. You don't know when gold's going to bottom, so you don't want to overcommit. But being that we think $14 is a very attractive price for Barrick by itself, there's no reason not to go there. Now, why is 14 an attractive price for Barrick? Let's go back to that because you shouldn't take everything I say on, you can't just say because Phil said so. But GOLD, currently at 1760, it's $32 billion in market cap. And Barrick makes, and you don't look at 1 year, you look at all the years. So this was a bad year for them, obviously, but they spent money on stuff. This was a rebuild. This was a year they retooled and redid some stuff and moved mines around, but they made 650 after that, 14. They lost 15 that year, made 4 billion, made last year 2.3 billion, 2.1 billion, 2.2 billion. So their projections going forward are roughly where we are now. And it's 32 billion. So you're paying 15 times earnings. Now, if we drop down to 14, that's a 20% drop. That would take this down to 26. And we're not expecting if we're earnings down, but if it's 26, then we're paying 13 times earnings or less. So they have the capability to have a really good year once in a while. They also have the capability to have losses. But overall, you can be pretty sure they're going to make somewhere in the $2 billion range. And that means that you're only paying 13 times earnings for this company going forward at 14. So that's why we're pretty comfortable with that level. Also, again, knowing that we like Barrick when the market goes bad because Barrick starts buying up their competitors. And that's what happens here, by the way. That's when it goes. So they buy up competitors, they get more mines, and they sell off competitors. Though they did a merger too. At some point around here, they did a merger with Goldcorp. And it hasn't kicked in. It's kicked in sales, but they haven't got the efficiency going, right? You can see the sales popped up. They went from 8 billion, 9 billion to 12 billion because they acquired Goldcorp, but not hitting the profitability yet. That'll happen in the next round where they sell off mines. And what happens is they sell off these mines and they write things off. They sell off underperforming mines. And sometimes they'll take a loss. They don't want to run the underperforming mines. And that gives them write-offs down the road too. But the bottom line is, from a valuation perspective, as a company, and you've always got to look at a company, would I buy this company? If I had $30 billion, would I buy this company? And if that's not what you would do with $30 billion, why are you buying the stock? It doesn't make any sense. And you got basically the same thing with Wheaton. So Wheaton is $17 billion at this level. And they're definitely a higher price, higher thing, but they're all over the place. But they're going to make $600 or $700 million. So that makes this let's see, if it's 20, it'd be 14 billion. So they're in the 20s. So their PE is higher, but they don't have the danger of Barrick, because they don't own the mines. They own paper. They're just trading the paper. And if the price gets lower, they buy lower price paper, then they sell that. And if things, when things are high, they sell more, and when things are low, they buy more. It's a very simple operation. So they're a good, steady company, and when you get a chance to buy them on a dip, they're good to buy on a dip. If you look at the longer term chart, they're just now coming down to a better price. But like I said, I would certainly go for gold over Wheaton right now, because Barrick, if you look at 5 years, this is about as low as they get. $17 in this channel. If they have a real bad sell-off, 13, 14. But like I said, you can count on them coming back to this 14. Where's 14? 14 is here. So you can count on them coming back to 14 pretty easily. That's something I don't mind hanging my hat on. So, and again, it's scaling in though. You're going to buy a position now that you don't mind doubling down on for sure, and you take it that way. But Barrick's a better price, a better buy at the moment than Wheaton is. But Wheaton is also heading down. So if we're lucky, they both get really cheap. And we already own both in our portfolios anyway, so they're just both good stocks to have. But that's how I play it. I would not play gold. You never know which way it's going to go, or silver. At any given time, you can get killed. Brian says, do you have a 2024 trade for Hewlett-Packard? Well, it'd be the same as the 2023 one we did, except for 2024. Where was that? Was that a top trade? Pretty sure we just did them as a top trade. Oh, Rewalk. That's right. Rewalk took a huge hit. They sons of bitches. We came in here at 250, and then we're gonna have to already adjust this thing. We came in 244. We sold the 250 calls, and we sold the 250 puts. So we're gonna end up with a big position here. And these were 75. The January 250. Oh, they don't have the long-term options. So we are going to get stuck with a bunch of these. Rewalk raised money selling, what do you call it? Not options. Oh my God, I can't think of the name. Anyway, they sold stock. They sold stock for $2 basically. I swear I cannot. I'm blanking on what it's called. Used to do them all the time too, but they did a sale at $2 of their stock to raise capital. So that sent thing plunging, and so we're gonna have to wait a while for it to come back now, unfortunately. So we just came in, and they screwed us and turned around and did it. Oh, we just did Barrick. Wait, why does it say Gilead? Oh. Further down. That's funny. That was just thrown in there as something we were talking about during that chat. Warrants. That's the word, warrants. They had warrants for $2. Anyway. Okay, so here is the gold play. Oh, there you go. So it's basically the same thing. See exactly what I just said. $20 puts, 17.25 spread in that case. That's what I was going for here. And in fact, here we did a half cover. We didn't do it full. Yeah, we didn't even do a full cover here. So that was aggressive. This is $1,400 on a $5,000 spread. What are wheat and precious metals? So I was just talking about the same thing. See, it comes up the same way. So we were talking about wheat and precious metals, and I said, I think exactly what I just said. We talked about wheat and precious metals. I said, I like these guys, but gold is a much better play right now. And here's a much more details than we just went into on gold and why it's a good play. So that easily explains that one. That was only a few days ago, last week. KHC, Halliburton, Boyd. I could have sworn we did Hewlett-Packard. There it is. All right, well, a while ago now. Wow, that feels like so recently. I guess it wasn't that long ago. It was only really August 1st, basically. So in Hewlett-Packard, 2024s weren't out, but this was from the end of July, and here we are at the same exact place. So basically, it's going to be the same trade, just change the numbers to 2024. We took the 25 puts, we sold them short, and again, it's the same concept. We're at 27. We feel very, very comfortable owning Hewlett-Packard at 25, and then we picked up the 22-30 bull call spread, and that netted 67.50 on a $20,000 spread with $13,000 upside, 200% upside profit potential if HP can be over 30, that line right there. So in 2024, you'll probably do better. You'll probably get better, a lower price for the same spread, basically, you should get, because you're going to be selling more premium. So I love that one. Hewlett-Packard's a fantastic company, ridiculously undervalued. I don't even understand what they're doing there. And again, I have long said that Hewlett-Packard, when they are commercially viable, will begin selling 3D printers. When they make sense to sell, Hewlett-Packard will sell them. Right now they're toys, but soon they are not going to be toys anymore, and people will be using them on a regular basis. People will be using for all sorts of things. For one thing, one interesting thing a 3D printer can do, a restaurant can print its silverware. So whenever it needs silverware, whenever it needs spoons, knives, forks, whatever you run out of, print it and just pop them out. We could obviously already do this with plastic if we wanted to, but it's not speedy enough and fast enough and whatever. But when a restaurant can push a button, and the way a copy machine works, forks will start popping out of the thing, like 100 forks in like 5 minutes. Then you got something, right? And that's the future of 3D printing. They can print dishes, they can print forks, they can print stuff. You can put, and then you take all those things, you wash them off, you throw them back into the whatever recycler that turns it back into the raw material to do it again. So for the next service, all brand new plasticware again from the previous one. So you're saving the environment, you're recycling, you're not wasting anything, you're doing things to order. There's a lot of good reasons to go these ways, and there's a lot of things. Think about all the takeout stuff and containers. You can print the containers, you can print the you can print bags, you can do all sorts of things. There's a lot of ways that you can use 3D printers in the very near future that's going to eliminate a lot of waste. You know, I was at this environmental symposium talking about things like that, and it's actually kind of cool. I mean, you look at stuff like that and you say, you know what, we might have a future. If we can get over this hump, we can actually start fixing things and have a much better future. But it's a big hump that we have to get over first. So hopefully I'll see you guys on the other side. But we're gonna all right, so that's gonna be it for this week, and we'll see you guys again next week. Thanks everybody for coming. I appreciate it.